Good day everyone, we are good too. Today we will be presenting our finding for our assignment for the course BKAFK1023, Introduction to Financial Accounting. First, let me introduce our team member. First is Shakira Saecho. The second is Sandira Mugi, anak perempuan Kumaran. The third is Diva, anak perempuan Sasai Kumar. And me, Shawendi. And lastly, we have Nur Syahidatu, Shakila binti Mod Kiyomi. For this presentation, we will focus on 1.0 company background, 2.0 the main business activity of two children company, 3.0 financial relation of the two children company, 4.0 comparison for the relation between two children company, 6.0 conclusion, 7.0 reference. So let me begin with introduction for these two company. The Alcom Group Berhad is a Malaysia holding company listed on the Bursa Malaysia main market, with core business in aluminium manufacturing and property development. This company aluminium segment, which includes Aluminium Company of Malaysia (BHD) and Alcom Nikkei Specialty Coating SDM BHD. It is a major and finished product. The company supplied its billets mainly to extrusion company in Malaysia and other countries. Iron operates one of the most advanced aluminium extrusion billet casting plant in the regions, using high-quality raw material to ensure product consistency and performance. Its products are used in various industries such as construction, automotive, furniture, and electronics. The company relations efficient production and environment responsibility in its operation.
Good morning, my name is Hadira Mugi Kumaran and my metric number is 310341. Today I'm going to present my part, which is two main activities that conduct by two company, which is Alcom Berhad and A-Rank Berhad. So for Alcom Group Berhad, their business actually started way back in 1960. Over time, they have built a strong reputation in the aluminium industry. One of their main focus is on producing their things like fine stock, building products, heavy gauge foil, and also other specialty in aluminium. These products are important because they have used in many industries, especially for cooling systems. Moreover, Alcom supplies a lot of its materials to air conditioner manufacturer across Asia and even Europe, which shows how trusted their products are internationally. They are also known as the largest aluminium manufacturers in Malaysia, and globally their materials have a strong reputations for quality and durability. Moreover, what's interesting that Alcom didn't stay in just one line of business. They have also expanded into property development and constructions. So now, besides aluminium manufacturing, they have involved in real estate projects and investment activities as well. So basically, Alcom Group Berhad has grown from traditional aluminium manufacturer into a more different company with a wider business portfolio. Now, moving on the next company, their core business is mainly centered around the manufacturing and marketing of aluminium billets. These billets act as the foundations for many aluminium-based products. So this part of their business is actually very important. By producing high-quality billets, the company is able to supply a wide range of industries that depend on the strong and durable aluminium materials. From these billets, the company manufactures various finished products. For example, they produce window frames used in buildings, automotive parts that help to support vehicle structures, and electrical components that are essential in many appliances and systems. They also supply constructions materials, which means their products play a vital role in development of homes, commercial buildings, and other projects. So overall, their manufacturing activities contribute to a lot of the sectors we use in daily and every day. Apart from the industrial side, the company is also involved in property holding and development. This means they manage properties as long-term investments, and they actively participate in developing new buildings or real estate projects. This not only in their income but also places in company as a strong position for future growth. So, when we look at their overall business strategy, we can see that they are not only focusing on producing industrial products, they are also expanding into property development. These combinations of industrial production and real estate activity shows the company's adaptability, how they are strategically growing by balancing stable manufacturing the operations with long-term property and investments. In short, the company has itself as both an industrial producer and as a property developer, which helps strengthen its sustainability and competitiveness moving forward.
Good day everyone, my name is Shakira Sechong and my matrix number is 310534. Today I'm going to present about 2.0 financial ratios of the two chosen companies. First of all, what is financial ratios? Financial ratios are useful tools that help us to understand a company's financial health and performance better. By looking at the key ratios like liquidity, profitability, and debt levels, we can see how well a company manages its resources and meet its obligation. By comparing these ratios between two companies, it gives us a clear picture of their strengths, weakness, and overall financial standing. Moving on to the next subtopic, which is 2.1 liquidity ratios. There are two types of liquidity ratios. The first one is current ratios and the second one is quick ratios. Right now, I'm going to explain and define the definition of the current ratio. The current ratio is a fundamental liquidity ratio that used to assess a company's short-term financial strength. It also measures the ability of an organization to meet its current liabilities, which obligation due within the next 12 months, by using its current asset, which are resources expected to be converted into cash with the same period. Besides, current ratio also helps to tell whether the company can settle the upcoming obligation, such as the trade payables, short-term borrowings, accrued expenses, and the current portion of the long-term debt, without facing the liquidity problems. A higher ratio also indicates that the company has adequate the cash reserve, receivables, and inventories to manage the operational needs and debt commitments. Right now, we are looking at the formula of the current ratio. We can acquire the current ratio by dividing the current asset with the current liabilities. Based on the table given, we can know the current ratio between both of the company, which is ARM Berhad and Alcom Group Berhad for the year 2023 and 2024. For the year 2023, the total of the current asset of the ARM Berhad is 267,011,107 ringgit, while the current liabilities of ARM Berhad for the year 2023 is 131,563,470 ringgit. By dividing both the current asset and current liabilities of the year 2023, we can get the total of 2.0. For the year 2024, the total current asset of ARM Berhad is 244,032,519 ringgit, while the current liabilities of ARM Berhad for the year 2024 is 124,281,447 ringgit. By dividing both of the current asset and current liabilities, we can get the same total amount as the year 2023, which is 2.0. For the year 2023, Alcom Group Berhad have the total of current asset of 358,034 ringgit, while the current liabilities of Alcom Group Berhad for the year 2023 is 190,095 ringgit. By dividing both of the current asset and current liabilities, we can get the total of 1.9. While for the year 2024, Alcom Group Berhad have the total amount of current asset is 408,580 ringgit, while the current liabilities of Alcom Group Berhad for the year 2024 is 315,405 ringgit. By dividing both of the current asset and current liabilities, we can get the total of 1.3. Right now, we are looking at the diagram of the current ratio between the two companies, which is ARM Berhad and Alcom Group Berhad for the year 2023 and the year 2024. As we can see, for the both year 2023 and 2024, ARM Berhad have the same total amount of the current ratio, which is 2.0, while Alcom Group Berhad is slightly different between the year 2023 and 2024, which is the year 2023, Alcom Group Berhad have the total current ratio of 1.9, while it decreased to the total of 1.3 in the year of 2024. Right now, I'm going to explain about the subtopic 2.1.2, which is the quick ratio. The quick ratio is also known as the acid test ratio. It's a liquidity ratio that used in the financial accounting to measure a company's ability to meet its short-term liabilities using only its most liquid current asset. The liquid assets are those that can be converted into cash immediately or within a very short period without relying on the sale of the inventory. In financial accounting, the quick ratio excludes inventory and prepaid expenses because they are considered the least liquid components of the current asset, while the ratio therefore focuses only on assets that can be quickly turned into cash, such as cash and cash equivalents, marketable securities, and the account receivables. Right now, we are looking at the formula of the quick ratio, which we can acquire by deduct the current assets with the inventory, and the total of it we have to divide it with the current liabilities. Based on the table given, we can see that the quick ratio for the both company, which is ARM Berhad and Alcom Group Berhad, for the year 2023 and for the year 2024. For the year 2023, ARM Berhad have the total of current asset of 267,011,107 ringgit, and it has to be deducted with the inventory total of 167,804,815 ringgit, while the total of it we have to divide with the total current liabilities of 131,563,470 ringgit. We can get the total of it with 0.8. For the year 2024, we can see that ARM Berhad have the total current asset of 244,032,519 ringgit, and it has to be deducted with the total current inventory of 150,476,162 ringgit. The total of it has to be divided with the current liabilities total of 124,281,447 ringgit. We can get the total amount of it by 0.8. For the year 2023, Alcom Group Berhad have the total current asset of 358,034 ringgit, and it has to be deducted with the total current inventory of 129,464 ringgit. The total of it has to be divided with the current liabilities total of 190,095 ringgit. We can get the total of it by 1.2. For the year 2024, Alcom Group Berhad have the total current asset of 408,580 ringgit, and it has to be deducted with the current inventory total of 220,723 ringgit, while the total of it has to be divided with the current liabilities total of 350 ringgit and 405 ringgit. We can get the total of it by 0.6. Moving on to the next part, which is the diagram of the quick ratio between the two companies, which is A-Rank Berhad and Alcom Group Berhad. As we can see, A-Rank Berhad remained the same ratio for 0.8 for both year 2023 and 2024, while Alcom Group Berhad had decreased 0.6 ratio from the year 2023, which is 1.2, to 0.6 in the year 2024. Here's a summary for the both current ratio and the quick ratio of the both company. A-Rank Berhad is more liquid in 2023 compared to 2024 because the current ratio and quick ratio is higher than 2024, so they can meet the short-term obligations. While for the Alcom Group Berhad, is more liquid in 2023 compared to 2024 because the current ratio and the quick ratio is higher than 2024, so they can meet the short-term obligation too.
Good evening. My name is Divya Sasukumar and my metric number is 303639. Today I'll be explaining the total asset turnover and accounts receivable turnover for both companies, which is A-Rank Berhad and Alcom Group Berhad. First of all, for total asset turnover, the formula for total asset turnover would be net sales over average total sales. And after calculations, we observe that the total asset turnover for A-Rank Berhad is 2.07 and the total asset turnover for Alcom Group Berhad is 1.10. Next will be the account receivable turnover for Alcom Group Berhad and A-Rank Berhad. The formula for account receivable turnover is net sales over average trade receivable. And after calculations, it is observed that for A-Rank Berhad, the amount we got is 14.52, while for Alcom Group Berhad, it is 10.67. Next is the comparison of both activity ratios. First of all, for total asset turnover, it can be observed that A-Rank Berhad holds a higher total asset turnover of 2.07 compared to Alcom Group Berhad with 1.10. This shows that both companies has a difference of 0.97. This also leads us to further assume that A-Rank Berhad is more efficient at using its assets to generate sales compared to Alcom Group Berhad. As for account receivable turnover, A-Rank Berhad still holds a higher account receivable turnover at 14.52 compared to Alcom Group Berhad at 10.67. There is a difference of 3.85 between both companies. This shows us that A-Rank Berhad is more effective at converting credit sales into cash and is probably less likely to face a risk of uncollectible accounts.
I'm Chamandy. My metric number is 312543. So now I will continue by the subtopic 3.3 profitability ratio. This 3.3 include profit margin on sales and return on common shareholders' equity, which is ROE. Profit margin is an important indicator of how effectively a company converts sales into net income. For the ROE, it reflects how effectively a company uses shareholders' equity to generate profit. So let me begin with the profit margin on sales for these two companies. For the years 2023, A-Rank Berhad achieved 2.26% of profit margin on sales. It means that the company generates 2.26 cents of net profit for every 1 ringgit of sales. For the Alcom Group Berhad, it achieves profit margin on sales of 2.49%, and it shows that the company generates 2.49 cents of net profit for every 1 ringgit of sales. For the year 2024, A-Rank Berhad achieved 2.15% of profit margin on sales. It means that the company generates 2.15 cents of net profit for every 1 ringgit of sales. For the Alcom Group Berhad, it achieved negative 0.63%, and it shows that the company incurred a net loss of 0.67 cents for every 1 ringgit of sales. Next, based on the profit margin on sales diagram, Aaron Berhad shows a decrease in profit margin on sales from 2.26% in 2023 to 2.15% in 2024. And for the Alcon Group, Berhad shows a decrease in profit margin from 2.49% in 2023 to negative 0.63% in 2024. Next, the return on common shareholders' equity for Aaron Berhad and Alcon Group Berhad. For the year 2023, Aaron Berhad achieved 1.39% of ROE, and it means that it is generating 3.21 cents for every 1 ringgit of shareholders' equity. However, Alcon Group Berhad achieved ROE of 8.36%. It shows that the company generates RM 0.0836, which is 8.36 cents for every 1 ringgit of shareholders' equity. For the year 2024, Aaron Berhad achieved ROE of 8.6%. It means that it generating 8.6 cents for every 1 ringgit of shareholders' equity. For Alcon Group Berhad, it achieves ROE of negative 1.65%. It shows that the company incurred a net loss of 0.67% for every 1 ringgit sales. Based on this return on common shareholders' equity diagram, we can see that the return on common shareholders' equity for Aaron Brand show a strong improvement, which is increasing from 1.39% in 2023 to 8.6% in 2024. Besides that, the Alcon Group Berhad shows a decrease in ROE, which is 8.36% in 2023 to negative 1.65% in 2024. In conclusion, for the Aaron Berhad, this company achieved profitability, improving especially strong ROE growth in 2024. Besides that, for the Alcon Group Berhad, this company facing a serious financial challenge with both indicators turning negative, which is profit margin and return on common shareholders' equity.
Hi and Assalamualaikum. My name is Norisha Dato Shakila binti Muhammad Helmi. My number is 310207. Today I would like to share about my slide, which is 3.4 leverage ratio. So, what is leverage ratio? Leverage ratio is a financial measure that shows how much a company uses debt to finance its asset or operation. So, in this slide, leverage ratio has two types. The first one is debt to asset ratio, and the second one is debt to equity ratio. So let's move to the debt to asset ratio table. So for the formula is total liabilities divide total asset. For Aaron Berhad, in 2023 they get 0.53, while in 2024 is 0.49. So for group Alcon Berhad, the data in 2023 is 0.57 and in 2024 is 0.65. So we are going to conclusion part. Based on calculation debt to asset ratio of Aaron Berhad show decreasing trend for group from year 2023 to 2024. It shows Aaron Berhad is a healthier financial position, while Alcon Berhad show increasing trend in group. It leads to get a higher financial risk. So this slide is show about stable debt to equity ratio. For group Aaron Berhad, debt to equity ratio in 2023 is 0.52 and in 2024 is 0.72. While Alcon Group Berhad is in 2023 is 0.69 and in 2024 is 1.46. So based on the calculation that show debt to equity ratio Aaron Berhad, the debt to equity ratio increased from 0.52 in 2023 to 0.72 in 2024 compared to Alcon Berhad, which is also increased from 0.69 in 2023 to 1.56 in 2024. But the increase from ratio Aaron Berhad is smaller and more moderate. This shows that Alcon Berhad became much more high leverage and riskier than Aaron Berhad. So next is comparison. Based on graph 3.4.1.1, show compared debt to asset ratio between Aaron Berhad and Alcon Group Berhad for year 2023 and 2024. For Aaron Berhad, the debt to asset ratio showing decrease from 0.53 in year 2023 to 0.59 in year 2024. So this group use a lower proportion of debt to support their asset. On the other hand, Alcon Group showing increased debt to asset ratio from 0.57 in year 2023 to 0.65 in year 2024. So that's showing that this group are depend on debt in year 2024. Let's take a look to graph 2. Based on graph 3.4.1.2, it shows compares debt to equity ratio for Aaron Berhad and Alcon Group Berhad for year 2023 and 2024. So for average Berhad, ratio increased from 0.52 in year 2023 to 0.72 in year 2024. While Akam Group Berhad, the ratio also increased from 0.69 in year 2023 to 1.46 in year 2024. Even though both of group has the data that increased, but average Berhad has a lower debt to equity than Akam Berhad, indicating that Akam Berhad relied for more on debt and face a higher financial risk in 2024 than Arranged Berhad. So the last of my slide is the conclusion for comparison. So in conclusion, Arranged Berhad show a moderate risk in its debt to equity ratio from 0.52 to 0.72, indicating a manageable increase in debt usage. So in contrast, Akam Group Berhad ratio surged sharply from 0.69 to 1.46, showing a much heavier reliance on debt and has a higher financial risk. So this means Arranged Berhad remain more financially stable while Akam Group Berhad becomes significantly more leveraged in 2024. That's all from me.